Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The board of the Reserve Bank yesterday increased the official cash rate by another 25 basis points in its first meeting of 2023. Over the last couple of weeks, we've had higher than expected inflation data for the December quarter, suggesting more rate rises would be needed, but then a tumble in retail sales and perhaps signs of a cooling in the economy. But the Reserve Bank is set on taming inflation. Reserve Bank Governor Philip Lowe made that very clear yesterday, and that means increasing rates. It's certainly a tough time for mortgage holders. Gareth Aird is the Commonwealth Bank's Head of Australian Economics. Gareth, welcome back to Fear and Greed.
G'day, Sean. How are you?
Well, thank you. Now, any surprises in yesterday's decision, and not just the decision, but also the wording around the statement?
Not a surprise in the decision. We thought they'd raise the cash rate by 25 basis points, as did most analysts in the market. The surprise, though, came with Governor Lowe's statement. He made a hawkish tilt. So what that means in layman's terms is that he's, from where he was late last year, he's become more in the camp that's convinced he's raising rates. For me, the key change was they took out the reference to not being on a preset path, and Governor Lowe just basically said that further increases in interest rates will be needed over the months ahead. So his conviction on needing to take the cash rate higher from here is further entrenched. And as a result, we've had to put a couple more rate hikes in our central scenario for the Reserve Bank, where we think now they'll take the cash rate up to 3.85%. And prior to the statement yesterday, we thought the RBA was getting pretty close to pausing in the tightening cycle, particularly given in November of last year was when they first started talking about potentially pausing. And yet reading the statement yesterday, the governor sounds very committed to continuing to raise rates. So pretty much all analysts now across the sell side have had to put in more rate hikes in their profile for the Reserve Bank.
Far be it for me to criticise Philip Lowe, but 12 months ago, he was saying there wasn't going to be a rate rise till 2024. Suddenly now he's become more definitive about the need for more rate rises. Things can change so quickly in economics. It surprised me somewhat that he actually took that stance because he didn't really need to remove that statement that you were talking about.
I agree. In fact, if they just kept what they said in December, which was that the board expects to increase rates over the period ahead but is not on a preset path, then they still could have increased interest rates in March and April if they thought that was the right policy choice. But equally, if the data evolves not in line with their expectations, they would retain full optionality to do whatever they think is right at those meetings. By removing the fact that they're not on a preset path kind of implies they are on a preset path. And therefore, it's almost like if you've committed to raising rates another 25 basis points in March and probably then in April, why did you not do 50 basis points yesterday? So a little bit surprised by all of that, but clearly the inflation data has spooked them out. They sound more concerned about inflation than they did 3 or 4 months ago, and yet they've delivered quite a bit of tightening in that period. And it looks like they've kind of dismissed all the other activity data or the soft data like the business surveys. I mean, the no business survey has been softening. The PMIs have been printing below 50. A lot of housing related data has softened, and retail trade was down in December. But it seems like the inflation data just trumped all of that, and they want to get on with it and keep raising rates.
How much of this is about jawboning? Because we know central banks like to talk up what they're doing, whether it's going up or down, because it kind of tells the market what's happening. Is it possible that the Reserve Bank is jawboning because it just doesn't want people to think that it's taken its eye off inflation?
It's an interesting thought, and we discussed that in our team once the statement came out, and we're thinking maybe the Reserve Bank wants to get a response from consumers and doesn't necessarily intend on delivering the hikes, but wants people to start acting like these hikes are coming. But having said that, we're only 4 weeks away from the March board meeting, and if you say yesterday that you think you're going to be raising rates next month, you probably then have to go through with it because you're not really going to see that much in the data over a 4-week period that should cause you to deviate from what you only just thought yesterday. So it's an unusual one. I'm just surprised that they sort of ditched the optionality of not being on a preset path. And look, if the governor thinks we've all interpreted what he put in his statement the wrong way, he can correct that at some stage. But from what we learnt yesterday, it seems clear that the Reserve Bank expects to be raising interest rates a couple more times over coming months.
Stay with me, Gareth. We'll be back in a minute. I'm speaking to Gareth Aird, Head of Australian Economics at the Commonwealth Bank. So can Australians afford it?
Well, for a lot of households, they're going to find things very, very tough as we go through 2023. If we're right and the RBA is going to deliver another 50 basis points of rate hikes, and that's pretty much what the statement yesterday hinted at, then you're talking about a cash rate of 3.85%, which would mean 375 basis points of tightening since May of last year. Now, the serviceability buffer that APRA asked the banks to use when they were lending throughout 2020 and 2021, when the cash rate was a record low, was 250 basis points above the loan rate. And that was increased in late 2021 to 300 basis points. But if now you're talking about 375 basis points of rate hikes, then a lot of home borrowers have not actually been assessed at their capacity to repay a loan with rates as high now as they're expected to get to. Now, that doesn't necessarily mean a home borrower will default, but it does indicate that there's going to be a lot of borrowers out there who are really struggling as we go through this year from a cash flow perspective, and they'll have to wind back their spending quite significantly where they can. And I think that's where, when you think about the lagged impact of rate hikes, that we were of the view that a pause in the not too distant future would be prudent, because you've got these lags at work, and you've got lots of home borrowers on record low fixed rates that'll be rolling off onto significantly higher floating rates as we go through this year. And they're obviously going to be rolling off even higher to an even higher floating rate now, based on what the RBA expects to do. So there will be a lot of households, I think, as we go through this year that find it very, very tough.
And that's probably not great for house prices. Well, it is if you're a buyer, perhaps, but it doesn't suggest that there's going to be a turnaround in house prices anytime soon.
No, it doesn't. In fact, you can imagine a lot of potential home buyers out there just sitting on the sidelines right now, because the Reserve Bank's basically told them they think they'll be raising rates further. And if rates are going to keep going up, I would imagine a lot of potential home buyers are happy to sit it out for a little while if they think they can get a cheaper property a little bit further down the line. It's probably going to take the Reserve Bank to not just pause, but for it to be pretty clear that rates aren't going any higher for buyers to really come back in any sort of significant size, and for home prices to stabilise. So in the short run, you can see home prices absolutely continuing to move lower. Given rates have gone up, they're expected to go up further, and of course that weighs on the capacity for a borrower to access money.
Now, we all have short memories, Gareth, or at least I have a short memory. When you have rate hikes and cycles generally, what are we looking for before we can start thinking that the Reserve Bank is going to pause? And in a sense, I know we've been talking about that for a few months, but just they were so determined yesterday to say rates are shifting upwards. What is it that we punters, not you professional economists, should be looking for to get some sort of sign of light?
It's a good question, because it appears that the central bank is looking for something that we think, if they see it, it might already imply that they've gone too far. Wages and inflation are backward-looking data. So if you're waiting for that data to peak and start to come down, there's a good chance you've already tightened too much. And equally, if you're waiting for spending data to turn, then by definition, if it turns, in other words, people are spending less, but you've got the lagged impact of hikes to come through, then there's a chance that you've actually engineered a hard landing. You should really be stopping in the tightening cycle before you see the data turn, because you're anticipating where things are going based on what you've already delivered. And that's why we thought the Reserve Bank would be happy to pause in the not too distant future, because they will have said, look, we've delivered a lot, rate hikes work with a lag, we've charted a course, now we're going to just watch the data because we think we've put enough tightening through. But the fact that it seems to be that their concern is primarily around the lagging data of inflation, that there's a risk here that they just go too far. I'm not sure what they're going to be specifically looking at to say, now it is clear that we don't need to keep hiking the cash rate. But the more they put through, the higher the probability that we get a hard landing, which is the very thing at the moment they've been trying to avoid.
And they're even talking about the narrow path of a soft landing. So it's almost like I'm sure they know that hard landing is an option, but I suppose a lot of us didn't think that would actually come to fruition, but maybe it will.
Yeah, that's right. I mean, they might take the approach as well that if they go that bit too far, they can always course correct and come back down. And that is the silver lining here, that if we're talking about a policy-induced slowdown that goes a little bit too far, well, then the obvious thing is just to cut rates. And clearly they're worried about inflation becoming entrenched. And that was the key takeout for me yesterday, that the Reserve Bank has really upped their concerns around the paradigm shifting, where inflation expectations ratchet up and therefore inflation becomes entrenched. And it's somewhat ironic to me that they've upped those concerns at a time when we can see that the global inflation pulse is actually starting to dissipate. And that, I would have thought, would have given the Reserve Bank some comfort that we won't end up with entrenched inflation. But we are where we are at the moment. And I think for people that are on mortgages out there, they've probably got to expect a couple more rate hikes based on what the governor said in his statement yesterday.
Gareth, thank you for talking to Fear and Greed.
It's nice to chat.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.